Talk series. I'm very happy to welcome you here, all of you here today. I see some new faces. My name is Laura Blyle. I'm the Assistant Director for External Relations here at Enterprise Works. And if you haven't been to one of our events and you'd like to learn more about the programs, feel free to stop by and talk with me or anyone else that you can figure out is identifiable that works here. Or you can all raise your hand. Dana? Anyone? Sherry? Some of them are back here, so anyhow. I'm really, really excited to welcome our speaker today, Karin O'Connor. Has joined our Entrepreneur in Residence program to be part of our team. Karin is a University of Illinois alumna, and I'm not going to go into her entire background, but of course she has a lot of experience in today's topic, which is angel investing. As the former managing director of the Hyde Park Angels, and which is, I believe, the largest angel network in the state of Illinois, in Chicago at least, and has continued, is not the managing director anymore, but has continued as a member of the group and has her own consulting company. So she is available to, as an EIR consultant, if you are interested in meeting with her, please feel free to fill out an EIR request. So without further ado, please join me in giving a warm Enterprise Works welcome to Karin O'Connor.
Okay, thanks so much, Laura, and it's great to see a lot of folks here today. I see some familiar faces, which is always good as well. As Laura mentioned, I'm Karin O'Connor. I am a member of Hyde Park Angels. We will talk a lot about what HPA does, but just to give you a little more perspective on me, I've spent my career in the investment business. I have kind of a funky background in that I've done everything from senior debt as a commercial banker, all the way down the balance sheet to common equity. I've done leasing, I've done mezzanine lending, so I have this really funky background. I've also been fortunate to work in a variety of industries and with companies all the way from a few people in a garage through to very mature hundreds of millions of dollar company buyouts. So again, a very funky background. I was introduced to angel investing in Hyde Park Angels about 5 years ago by a friend in the venture capital business. And she told me about this new group that had just gotten started. They were seeing a lot of really interesting entrepreneurs and deals, and that I'd have fun if I came along and checked it out. So I did, went to a meeting as a guest, saw 3 companies present, and immediately was kind of hooked on the whole idea of angel investing. I've since invested in 15 companies over the last 5 years, and we can talk a little bit more about some of those as we go along. So before we get started, and I do want this to be a discussion, so if there's something you don't understand or a topic you want to delve into a little bit more deeply, raise your hand, just scream and shout or whatever it takes. I want this to be about you. I put together some material, but if we don't get through it or if we go off on tangents, I'm totally cool with that as long as you get what you came here for. So before we get started, let's talk about what is angel investing. So who can tell me what it is? Oh, you're going to have to participate for that. What is angel investing? Who has an idea?
Okay.
Somebody said something over there. What is it? What is it?
Private investors.
Private investors. Okay. Is it like venture capital? No? What's the difference?
Venture capital uses other people's money. Angel investors from someone with high net worth, like an accredited investor.
Okay, so that's perfect. So venture capital is about using other people's money. And specifically, venture capital funds are groups of investors, they call the general partners, who have organized a fund, a pool of capital that belongs to outside folks. Generally, these are institutions, they're endowments, they're pension funds, they're corporate entities, they may be very wealthy individuals. But this money is being managed for them by a team of investors who's acting as sort of hired guns, right, as fiduciaries. Angel investing is different because an angel investor is investing his or her own personal money in the deals. Okay, and that's a really important distinction because it impacts how we make decisions and often the types of relationships that we have with our companies. Okay, so does that make sense? All right, so topics for today, we're going to start out really big picture. We're going to talk about angels and how important they are. Maybe more important than you think. We'll find that out. The rise of angel groups. 10 years ago, there really wasn't such a thing as an angel group in an organized format like Hyde Park Angels, the team I belong to. We'll talk about why these groups have gotten more and more popular and why they can be successful. And then we'll go a little bit more specific. We'll use Hyde Park Angels as an example of an angel investor group and talk a little bit about how we operate, what we look for in our companies, and the types of companies that we invest in. And then finally, if we have some time, we can talk about some trends and some things that are going on in the marketplace today. And I'd love to hear from you on that score because things are changing all the time. So does this sound good? We're all cool with that? Okay. Before we get started, because I know this is a school, so we're going to have to do a little quiz. But don't worry, it won't be great. On your table, there are some papers, and if you want to pass those around, I'm going to give you a couple minutes to answer them. They'll sort of set the stage for some of our topics here. Feel free to collaborate, by the way. Okay, I'm seeing some people start to look up. So each of these questions ought to be answered by the time we get to the end of the talk. If I forget something, let me know about it. Do we have any investors in the room with us today? I just want to know who the sort of cheating experts might be. So we have at least one. Alan's back there, I see him. Any entrepreneurs that have taken angel investment? Okay, so you might want to contribute to the discussion here as well. So all of that's good to know. Okay, so the first question, angels versus VCs, which group invested more in 2013? We still don't have 2014 numbers out, so we're going with 2013. Things don't change all that much though. So we talked about the difference. You've got the venture investors who are managing these institutional pools, and you've got the angels who are investing their personal capital. So which group invested more in 2013? What do we think? What do we think? Alex, what do you think?
I'm going to guess it was the angels, because otherwise the question wouldn't be on the question.
Oh, you think?
I didn't I have no idea.
Okay. So that's kind of a smart answer. All right. Does anybody think VCs? Okay. Think VCs, Roger? Why?
They do it in bigger chunks.
Okay. So they're bigger chunks. All right, so now we're going to vote. I'm going to make everybody take a stand here. Who says angels? Who says VCs? Okay, kind of half and half. All right, here's the answer. Which one is it? Okay, so it's VCs, but not by a whole lot. Right? And there have actually been a couple of years, you can probably guess which ones those were, sort of when the economy was kind of, low, where the venture folks weren't doing too much at all. So, does this surprise you? Is this a lot of money? It's kind of a lot, isn't it? So what else do we notice when we look at these two charts? What else do you see here? Differences between angels and VCs.
The more angels are more global.
Okay, I'm sorry, what was that? Back here? I heard somebody from up here. What did you say? Difference in the number of companies. Okay, that's a big difference in the number of companies. So not that much difference in the amount of capital, but a big difference in the number of companies. So what does that mean?
Investing in smaller companies.
Investing smaller amounts at least. And I think from there we can kind of extrapolate that the companies might be smaller. And if you do the math on this, The average angel investment size, which I think is another one of your questions here, is around $350,000. The average size investment from the VC side is around $7 million. So that's a big difference, right? So what does that imply about the types of companies that are getting investment from these two groups?
Different phases.
I'm sorry?
Different phases.
Different phases. And in fact, we have a little bit of a statistic there too. What is the difference there? What does that mean?
Angels are much more tolerant to risk.
They're much more tolerant to risk because they're investing in younger, earlier companies. The venture guys are investing more in companies that have proven out more. Not to say that they're proven entities, and these guys lose a ton of money. I can't tell you how many $10 million investments I've seen where the whole thing just disappears. So that is by no means riskless, but they're investing in something that's typically a little bit farther along, right? What is something else that we might notice about these statistics that might be interesting? What?
Not too many companies that get
Okay, that's huge. Okay, this is huge. So for those of you who might not have heard it, what he just said is not too many of the companies that are getting the angel investment looks like it ends up in the VC, right? Because you've got 70,000 companies getting angel investment and only 4,000 getting VC money. So what happens to those other companies? What are some things that might have happened to, that's a lot of companies.
They go out of business.
They might have gone out of business.
Acquired.
They might have gotten acquired.
They might have gotten to a point where they're self-sustaining and they don't need to take on additional capital.
I'm sorry.
They might have gotten to a point where they're self-sustaining and they don't need to take on additional
That's
capital.
possible. It's possible they never needed any more money. It's possible, too, that they become, you know, what we call lifestyle businesses, right? Because keep in mind that these venture guys are looking for home run, huge billion-dollar business opportunities. If something looks like it could turn into a solid $50 million business, that is not interesting to an institutional venture investor. And the reason is that they're putting so much capital to work and taking such big risks that they really need to shoot for big home runs. So when you see companies that didn't get venture investing, it's not necessarily that there was something wrong with their idea, it just might have been too small of an idea. Angels, on the other hand, might, not always, but might be interested in going ahead and backing something like that. Because they can make money that way. So what do we think about this 25 most active venture investors, accounting for 35% of the total deals? What do we think about that? What if I told you there are about 500 active venture firms in the country? 25% of them are doing 35% of the deals.
It's a log normal distribution. There are a very small number that are putting out lots of money
Right.
and then it just falls right off. And in fact, it looks like it might even be that when you look at the total number of people out there, that the ventures are putting on the big bucks, and then the smallest ventures are about the same as the biggest angels, and it just falls off.
Yeah, and I think this is a really interesting analysis here, because you know what's happened is these venture funds, the successful ones, have gotten really big. This is not a successful industry, by the way. If there are venture people here in the room, sorry to burst your bubble on this, but it is not, as an industry, been very successful. There are a few funds that have been really, really, really successful. And you probably know their names. They're called Benchmark and Sequoia and Axel Partners and Main Ventures. You know, these are the names that we tend to associate with the industry. But they are the minority. And in fact, if you look at the return distribution over time, it is way out of balance. So what happens is these successful firms raise bigger and bigger and bigger funds. They dominate the industry, and to an extent they control industries. If you go back to .com, there are a lot of those funds were very successful during that day, because they were the ones who got the ball rolling, and by the time everybody lost their shirts, they were already out. So, kind of an interesting story. Okay, so let's get back to the angel investing. Who are angel investors? What kinds of people are these? These are some of my actual colleagues from Hyde Park Angels. And you can see, you know, we've got some diversity, not as much as we'd like, quite frankly. About 20% of our group is women. We have a bit of an age distribution. We tend to be more middle-aged to older, but we have a bit of an age distribution. But what kinds of people want to do this? Where do you think they come from? Yeah?
They could have previously been entrepreneurs before.
Yeah, so serial entrepreneurs. And these can be either folks who have led a high-growth enterprise that maybe cashed out, and they're kind of coming back and reinvesting some of their gains. They can be folks like this fellow with the pizza business. You know, he's a mid-market entrepreneur, right? So they never took venture money, but he and his brother grew a successful frozen pizza business. So they may be that kind of an entrepreneur. Who else might want to do this?
Doctors.
Yep.
High-income individuals.
Yeah, and you know, and sometimes people veer towards an industry that they know, or you know, where they have specific expertise, right? Doctors would be an example of that, oftentimes. You also might have venture people who, you know, don't get to do these young, early, smaller deals anymore. And I would sort of put myself in that category. The woman up in the top corner there, she's definitely in that category. So we have a few of those kind of venture capital refugees. We also have advisors, you know, lawyers who work with young companies, see a lot of deals, people who are consultants who kind of like to work with something that's newer and younger. The SEC right now says that you have to be an accredited investor in order to participate in the angel world. Does anybody know what that is? Have we heard that term, accredited investor? So that means that you meet some minimum financial tests around net worth or income. The Jobs Act that Congress passed a couple of years ago has provisions for sort of cracking the door open for investors who don't meet those criteria, kind of letting more people get involved in equity investing. You know, you may be familiar with crowdfunding. Crowdfunding in terms of equity ownership right now is only available to accredited investors. The reason is that even though Congress thought this was a great idea, the SEC thinks it is a horrible idea. And so they've really dragged their feet on creating the regulations to allow, you know, non-accredited investors to participate, though it's supposedly coming. So we'll see. But that's a minimal test that people have to meet. So why now? Why is angel investing popular now? 10 years ago, as I said, not really so much the case. What are some things that have changed over the last 10 years, and really over the last, say, 6 or 7 years, that make this something that people are interested in doing now?
Venture's getting more.
So that's a really important point, is that venture partly is getting more risk averse, but it's definitely seeking larger investment opportunities. So they're looking for opportunities to put bigger wads of capital to work. You know, we looked at 7 million being the average. A lot of deals are bigger than that, right? So that makes it harder for them to invest in these younger companies. At the same time, what's happened, and I'll give you this, because these two things are happening in parallel, what's happened to the cost of getting a company started? And I think we can specifically look at digital companies. I know a lot of the companies that are started here are not digital, but what's happened to the cost of starting a software company?
Decreased tremendously.
Somebody,
The cost has gone down.
Gone down, okay, and gone down a lot. So Forbes did an article, this has been a couple years ago now, but it's really, really interesting. If anybody wants it, I'd be happy to send it to you. So in 2007, they estimated the cost of getting a software company up and running, and they itemized it in terms of what you have to, you know, have, what resources you have to invest in, just to get the product built. This isn't going out and marketing. $600,000 just to get the product built. What do you think that same kind of model would take in terms of capital 5 years later, 2012?
60,000.
How much?
60.
Okay, anybody else have a guess?
10,
What?
10K.
10? 10K? Okay, in between, 50. And why? 600K in 2007, 50K in 2012. Why? What the heck? What happened?
The cloud came out.
The cloud came out. Okay. The cloud is a huge part of it. In 2007, you had to buy servers. You know, we don't even think about that anymore. And then you had to have a space for the server. You had to have people to manage the servers. You had to go buy a license from Oracle, $30K, Microsoft Office, $25K. I mean, all of these things. Now we think, well, who's going to go pay $25K when you can just use Google Docs? Right? So, and this happens so quickly. You're even laughing. You don't even remember those days, do you? So, you know, so this happens so quickly. So what happens now? You've got companies getting started for next to nothing. And you've got venture funds who have to put big capital to work. So this mismatch got bigger and bigger. At the same time, this has enabled smaller pools of capital to get a company fairly far down the line, to let it build a product, start testing out customer acquisition, start getting far down the line. And that's where the angels come in. Right? So we're not taking nearly the risk we would have to put smaller dollars to work. So there you go. At the same time, what's happened on the other end of the spectrum, the exit end of this? What happens to companies that are successful, startups that are backed by angels or VCs? What are the things that can happen if it works? Yeah. They get acquired. Okay? What's the other big thing that can happen? IPO. So the IPO market now has come back, but it was dead for a long time. If you're a venture fund, you need to have a robust IPO market in order to get your returns. Because you're not going to get a big enough exit unless it's some crazy thing, right? Like WhatsApp or these others. But in general, you're not going to get big enough exits from a sale to a strategic to make it worth your time to do these deals. But with angels, it's a different story. A lot of times, to be perfectly honest, we as angels are better off getting the company to an early exit, you know, getting some traction, some success, and having somebody come in and buy them for $30 million, $40 million. Then we are trying to go out and raise bigger dollars from a VC, which is going to dilute our interest, and which is also going to set up a situation where the company has to grow really, really big to satisfy the venture investor. And a lot of models just will never get there. So sometimes this is the thinking that we go through. Are we better off looking for an acquirer? The good news is there are a lot of companies out there that have lots of cash, and they're not growing very fast. And so they are looking for hot growth opportunities that they can pick off and acquire. So there's a really big market for that. Now, more recently, we're seeing lots of corporations interested in investing alongside us. That's a more recent phenomenon. Forming venture groups or other sorts of you know, pockets where they're actually taking minority stakes in companies and partnering with them in different ways. So that's kind of interesting. Our group just partnered with a corporate on a deal, and it's very interesting. So we'll see how it works out. Okay, so why do we want to invest with a group? If I want to be an angel and I've got money to put into companies, why don't I just kind of do that on my own?
Risk pooling.
Risk pooling. Okay. What does that mean? I mean, I'm not going to invest. You know, a lot of our folks do $10,000 to $20,000 with Grow, right? That's kind of our minimum is 10. What kind of deals am I going to see if I'm putting in $10,000 a time? Small ones? Maybe not. I might see good ones, but I'm not going to see very many, right? Because I'm not going to be a hot stop for an entrepreneur that's got a really great idea with my $10,000. But if I'm part of a big group that together is putting in, this may be another question here, anywhere from $250K, which is the minimum that our group will do as a group deal, all the way up to about $1 million, suddenly dealing with me becomes a whole lot more interesting. And I'm starting to see a lot more of what's going on. And why is that important? Why do I want to see lots of things? Don't I just really want to find one good one? Why do I want to see lots? Pardon?
Catch the best one.
Yeah, I mean, how am I going to know that I'm seeing the best ones unless I see a lot? Especially because you usually end up seeing 3 or 4 that are trying to do something similar or attacking the market in different ways. So we're learning all the time, every meeting, and having a robust deal flow is a big piece of that. Okay, so that's one reason. Why else would I want to be part of a group?
you don't know everything, and having
Well,
your
I
peers,
do. Most people don't. Right.
having peers around you to help fill the gaps or leaving information.
Yeah, so we're sharing expertise.
Exactly.
We're sharing expertise, and in a group like ours where you have everything from practicing physicians to entrepreneurs who have heavy-duty operations experience to folks who've done digital media, this becomes a really important factor. There's almost always at least a first-degree connection from someone in the group that knows something about anything. So we can always network our way into somebody with some expertise. So that's a really important piece of it too. What else might you think? What about deal terms? If you're investing on your own, unless you're big, if you're Bill Gates, you can do whatever you want. But if you're investing on your own, what kinds of deal terms do you think you get? Good ones that investors like? No, probably not, right? So you're not in a good position to negotiate a decent deal. Which is not to say we're taking advantage of entrepreneurs, because if you do that, you're just setting yourself up for a big mess. Nobody wants to do that. But within the group, we have deal structuring and pricing expertise. And again, because we've seen a lot of what's going on, we have a really good sense for the market. So we know sort of what market pricing looks like. We know how to set up deals so that when the venture guys do show up, they've got something that they understand. It's not hairy and scary and just a pain that they're going to walk away from. We set up a deal in a way that's really easy for them to layer on top of. So we're getting that sort of expertise as well. Now, what's one final reason that's not overly analytical or complicated, but why would you want to invest with a group instead of on your own?
You get access to a large network
You
of
do.
people with experience.
Yep. Larger network, very definitely. We can be more helpful to the entrepreneurs. That's coming up on the next slide. Yeah?
Validation.
Validation. Okay, but you guys are being way too scholarly here. What's like a down and dirty? Why do we do anything in groups? Why do we go eat
Make
pizza in a
friends.
group? Pardon?
To make friends.
Make friends, it's fun. Yeah. It's fun. This is why we have a lot of meetings, and we always have food, and entrepreneurs come in, and we get to ask them questions. It's kind of like Shark Tank, it's like cool, and you learn a lot of things. So it's fun to do this in a group. And the more interesting expertise and smart people you have in a group, the more fun it is. So that's why we work with a group. Why does the entrepreneur like it? We've touched on a couple of these things. Access to a bigger pool of capital, right? He's not having to go around talking to, $30,000, $10,000 investors. He can talk to one who's a $300,000 investor.
Access to mentors.
Yep, mentors, okay? And not just mentors for advice purposes, but this big network for things like raising the next round of capital. We have connections that we use on behalf of our companies. Access to business development introductions. We have one company, it's our weight loss business, which, we all have reason for that, but, one of the reasons he brought our group in, this was actually a big venture deal with much larger investors. He cut our group in for a piece because he knew that our 120 members know a lot of people in the employee benefits arena, which is where he's selling. He's selling it as an employee wellness tool. And he wanted those introductions. We have someone who's on the board of Cigna. That was huge for him to get access to that person, to make high-level introductions to him there. So having that kind of a network can be a really big deal for the entrepreneur. Why else? Yep.
Well, you've got money.
You've got money, right. And we have a pretty straightforward decision-making process. The other nice thing is the way we set our deals up, we go in as one group. So we form an LLC entity that holds all the money. And that's nice because when you look at the cap table, which is the list of all the investors and how much they put in and how much of the company they own, we go in as one name. So it looks like an institution, it's a heftier sort of a look. If a venture investor sees a cap table that has 50 individuals, each in there for $10,000, it's not a real professional kind of a look. So that's helpful. The other nice thing is we have one vote. We vote our shares as one. So part of our routine involves appointing somebody to manage the LLC. And that person makes the decisions. You're not chasing down 50 people trying to get them to sign off on something. So it's a lot easier. And as I said, we know how to set deals up so that the next guy can come in and then it's all easy. So you get help with a lot of different things. Okay, so we'll talk a little bit about our group. How am I doing time-wise, by the way? Okay. All right, so we'll talk a little bit about our group. So Hyde Park Angels was founded in 2007. We're coming up on 8 years old. The group was started by a half a dozen classmates at the University of Chicago, in the business school there. And they sort of thought that there was this hole in the capital markets. And in 2007, there was a big hole, let me tell you. It's less so now. But for these smallish size deals. So we're talking about investments in the $1 to $2 million range, total investment size, where our group will generally play in the sort of $300,000 to $800,000 range. So we're going in with other folks. It's not just us usually. But these people saw this hole in the market, thought it would be cool to get a group together to start looking at deals, went to the Polsky Center for Entrepreneurship at Booth and convinced them to sponsor the group. So we stay affiliated with the University of Chicago, though only about half of our members have an affiliation with the school, mostly alums. And I'm part of the half that does not. So, you know, that broad base has really enabled us to attract a great group of folks. Right now we have about 120 members investing, actively investing, and we do set expectations. So our members agree when they join to invest a minimum of $50,000 a year. We give a couple years grace, so you don't have to do anything right away, but if you've been a member for a couple of years and you haven't seen enough opportunities that you're putting some significant dollars to work, you're probably not in the right place. And we manage to that, so it's pretty important. We have 3 paid staff currently. We're also blessed with what we call the Hyde Park Angels Associate Program, which is typically 4 to 6 MBA candidates from Booth who work for us as analysts. And they do a lot of the running around, the grunt work, the research, the financial modeling, you know, those sorts of things, which frees our members up to do more of the higher level strategic thinking and, you know, and other parts of diligence. So it's a huge help. So how do we support ourselves? How does our staff get paid? It says it right there. Do we take money from our companies? Does it look like we do? No, we do not take money from our companies. If you are an entrepreneur and an investor wants you to pay to get investment from them, big red flag. Big red flag. Which is not to say I've never seen it happen or been involved. I've never done it myself. But if somebody is saying I'm going to raise capital for you, that person is not an investor. They are an investment banker. And those are two completely different things. We do charge a $45 application fee. And we only implemented that because we were getting a lot of very not thoughtful applications. So it's designed to make the entrepreneurs think a little bit. But we would never pull money out of our companies. It's a huge investment. The dues right now are $2,000. They've gone up as we've had to expand infrastructure. We have a pretty robust infrastructure for a group, and you know, I ran the group for 3 years, as Laura said, and that was a big part of what we did was put this infrastructure in place. So it's great that there is a cost to manage it, and our members have been, you know, happy to go along with that. So we have funded, it says 30, they're actually 31, but one of the deals hasn't been announced yet, so we're not counting it. But we funded 30 companies, over $16 million in capital deployed. We have $2 million invested in our largest investment. That's over several rounds. That didn't happen all at once. So that's the biggest one. The smallest ones are probably about 150. Again, 250 is our minimum. We don't do the little ones anymore. We used to, but they got to be too expensive. Of the 30 that we have invested in, 5 of them have been acquired by strategics. Okay, so is that good? Okay, yes, this is good. Does that mean we made money on 5 deals? No, it doesn't mean we made money. And in fact, we made money on 2 deals, and we lost less money on 3 deals, is how it works out in this case. But given the circumstances, we found homes for the technology and for the employees. We've had 2 companies that have shut down, which is pretty good over almost 8 years and 30 companies. 2 of them have shut down, they just weren't working. One of them actually returned 40% of its capital, which was an interesting situation. It just was not working. And the entrepreneurs said, you know what, rather than continue to pay ourselves for the next 6 months with the money these people have invested, we're just going to call it quits and give it back to them. And that was really smart because the next time those guys have a company and they come around, people are going to remember that they did that they were stand-up guys. So we've only had one total loss, which is not bad. And thus far, 9 of our companies have been successful in raising follow-on rounds, next round money, in deals led by outsiders. Okay, there are others that have had insider rounds. Does anybody know why we make a distinction? Alex, what do you think?
Well, outsiders means somebody else has been convinced this is a worthwhile.
Yeah, that's right.
undertaking.
Right. Because the insider rounds, we all have a stake that we're sort of trying to protect, and that's a different kind of an analysis than someone brand new coming in and going, yay, and generally paying an up price. So the idea is that the share price is going to go up every time. That's kind of what we like. So we have some fairly significant paper gains built into some of the companies. Again, you can't spend those. They're still kind of working off their initial capital, so it's kind of too soon to tell. So you can see we've been kind of busy lately. So what are we looking for? When we look at a deal, what is it we're looking for? Any guesses? Oh, Scooby's so smart. Yes?
The team.
The team. We want backable management. What does that mean?
Coachable, smart, intelligent. They understand space.
Yeah. Coachable is a really interesting term, right? Because we debate this a lot. A lot of our members really want to mentor. And you want someone who's going to listen, who's going to be receptive, who's going to, to take constructive criticism well. But you don't want, Mr. or Ms. Milquetoast that's going to do everything the last person told them to do. So there's sort of a balance there. We want someone who's confident, who knows their market. I think back on the entrepreneurs we've had that have been the most successful, and they had done so much work understanding their market when they came to us. We want a team. We're not going to invest in one person. That's too scary and dangerous. We're looking for skill sets that complement and that sort of make a complete picture, at least for now. I meet a lot of folks who tell me they want to be a strategist in a startup. And I tell them, you know what, there's no such thing. In a startup, you're either building it or selling it. If you're not doing one of those two things, I don't want to see you. Right? Because these are what we have to do. We have to build the solution and we have to sell it to somebody. Those are keys. Okay, so we're also looking for big markets. We talked a little bit, and I sat in on the ICOR group today, and we talked a little bit about that. Whether a market's big enough to support a company that's going to get big enough to generate a good return for us. So we're looking for big markets. Generally, you want a market that's kind of in the $1 billion range before you start narrowing it down to what our niche is going to look like. We want pain on the customer side. We want customers to be in pain. VCs will make this distinction between investing in pain pills versus vitamin pills. They want the painkiller because the customers are going to pay a lot. If they're in real pain, they're going to pay for a solution to that pain. If it's a vitamin pill, if it's going to, cut a few costs for them, if it's a nice-to-have kind of thing, maybe not so much. It's interesting because one of the companies I'm involved with most closely is an e-commerce business. We resell used kids' clothes online, which doesn't sound like a pain, but if you have a 3-month-old baby, they're going to need new clothes in 3 months no matter what. So they keep growing. So we're almost a consumable. We're calling ourselves a semi-consumable company now. Because, getting clothes for your kids is not optional for people. So we want pain. We want a novel solution. Okay, if everyone else can do the same thing, or it's easy to copy what you're doing, that's not interesting. We want capital efficiency. What does that mean? What's capital efficient?
Good stewards of investors' money.
Okay, that's one piece to it, being a good steward of investors' money. One of the companies one of the first ones I did, and they've done really well, the entrepreneur had actually founded a very similar company during .com, and he blew through $7 million. And he's the first one to admit he made a lot of stupid choices about what to spend money on. He's been so much more, almost too efficient this time around. He's very focused on making sure he doesn't use the money in ways that aren't smart. So that's one piece to it. The other piece, though, is that we're angels. We don't have this giant fund or boatloads of capital to continue to shovel into the companies. Unlike the VC that wants to put in $10 million, we don't have that. So we need to invest in models that can get where they're going without crazy amounts of capital. Now this is our group. I'm working with some investors, angel people in San Diego, and they're investing in a lot of biopharma. I will tell you, our group is not going to do biopharma because you need $100 million to get through the FDA and everything else that's going to happen. We have no idea how you would manage through that as an angel group. These guys apparently think they have it figured out, and they've had some good success, so, you know, God love them. But that's something that we look at. This is why a lot of our deals are digital, because they're easily capital efficient. They scale pretty quickly if there's a market for them. Backable management, we talked about that a little bit. Their goal is to make 10 times our money in 5 years. How often does that happen? Often?
No, better be more than one deal in 10 or you're in trouble.
It never happens this way. You know, you can make, I heard one guy getting 20x, but it took 15 years, or, you know, we've made 1.2x, but it only took a year and a half. I mean, there are a lot of different, or you lose everything. That can happen real fast too, or slow. But yeah, the goal is, which is why we need to see these big markets, we need to see the big pain, which is going to translate into margins and customer adoption, because we want to see that there's a possibility that the $1 million we invest today can turn into 10, 5 years from now. You know, if that's not possible, then we can't really invest in it because we're taking huge risks, and we know that a lot of them are not going to pan out. If you look at research into angel investing, and there have been some academics who've done a lot of work around this, you'll find out that the sort of average angel return over, let's call it a 10-year time frame, where we invest for 5 years and then we harvest for 5 years, is around 2x. And within that, one company accounted for 75% of all the capital that came back to the investors. One. Yeah?
It could be a really dumb question, but what do you really mean by make 10 times? Are we talking, you don't have market capitalization at that point.
So
you're talking income, you're talking value?
Yeah, we are talking value. We're talking going in value and coming out value, right?
But
so
you measure it before you sell it. I mean, if it's an ongoing company, are you getting
So typically, that's a really good question, actually. We are always driving for an exit. You know, we are not investing in companies that we intend to hold on to forever and ever. So part of our analysis is, who would buy this if it works? And how much are they likely to pay? And this is hard, because who knows 5 years from now? You know, when I was in a venture firm years ago, we always used to do these calculations based on market cap, you know, public company multiples. Well, you know, we know in 5 years, there's no way it's going to be the same as it is today. But this was all we had, so we just would use that. But we're trying to say, hey, if this works, is somebody going to pay us big bucks for this? That's kind of where we're going with it. Now, one of the questions you have down here is around valuation. We have to be really careful not to pay too much for these companies, because that is a big deal on the other end. So what do you think that average valuation would be for an angel-y kind of company? Let's call it, it's got a product build, solution ready, you know, maybe a little bit of market activity, but no real customer traction yet. Yeah?
Probably about $1 million.
I'm sorry?
$1 million.
$1 million? Anybody else want to hazard a guess? How much? $250,000. Okay, that would be a founder deal. That'd be a super early deal, which is not to say we haven't ever done that before. Yeah. 500K. Okay, so the average angel deal, again, if you look at statistics that our trade association keeps, is around a $2.5 million pre-money valuation. So just because this pre-money is this term that floats around, what that means is that that's the value that we put on the company before our money goes in. And that is what tells us how much we own of the company after we put the investment in. So let's say we all agree that this company that you're bringing to us today is a $2 million pre-money valuation company. We're going to invest $1 million. So how much is it worth right after the valuation? $3 million. We call that the post-money valuation. How much of that company do we own on that day? How much? A third, right? We put in 1 of the 3, so we own a third of it. So let's say that company, we never need any more money, and 5 years from now, we need for that company to be sold for $30 million, and then we get 10. So we put in 1 and then we get 10. So it's all on cash. You know, people say IRR, but that doesn't really matter that much because you can have a really big IRR because it flipped fast, but you can't buy a hamburger with the gain. So we're really looking for a cash-on-cash return that's 10x. I personally have never had that. I've had 4, but not 10. We're still working on it though with the companies. Okay, so does that make sense? Does anybody have any questions about that? How am I doing time-wise? I see Laura getting it.
12:53.
Okay, so we need to wrap up here pretty soon. So if there's something that you're not understanding, let me know. Okay, these are our companies. And every time I do this talk, I have to squeeze more logos onto this page. So I'm trying to figure out how to separate them a little bit, which maybe I'll do the exited ones and the current ones. But anybody know any of these? Yeah, who do you know? Parkwiz. Have you used them? You know them as a customer? Okay. Anybody else know Parkwiz? What do they do?
It's kind of like helps you find parking spots and kind of monetizes what the price is of every parking spot.
Yeah, so you can pre-reserve and prepay, and it's lower cost. They do a lot of work with events. So they've got a deal with StubHub, actually, where they're selling, parking for events that StubHub's selling tickets for. So if you go to a football game or whatever, you can prepay with Parkwiz. Any other companies up here that anybody knows? Yeah.
New Current,
What do they do?
charging.
Wireless power, right? Yeah, that's technology out of Northwestern. That's one of our newest investments. I think that one closed in October. But it's really exciting. They were just out at the Consumer Electronics Show. They were being shown off in a bunch of different products. So it's very interesting technology. And that's hardware too, so that's a little different. That's the one we co-invested with our partner Molex. Molex is in that deal, and Molex is going to manufacture the product. So that was part of the whole scheme that we went in on, which was really pretty cool. Anybody else see anyone they know? No? I thought you all would know farm logs. I mean, that you're farm-oriented. The sort of ERP for farmers. That one has raised a ton of money from venture. That one is very hot in the market right now. Simple Mills gluten-free muffin mixes. Buy them on Amazon.com or at various Whole Foods. It's a very diverse portfolio. This is part of the fun of having 120 members. There's always someone interested in something. SonarMed is a medical device that monitors the positioning of breathing tubes. So if a tube gets out of whack, an alarm sounds and the nurse can deal with it right away. So big market in neonatology. Because a baby with a breathing tube out of whack is in trouble really fast. Moxie Jean is our online kids clothing company. Fishity, it's a social network for fishermen. Mobile access to hotspots maps from every lake, river, etc. in the country. Plus, you can take pictures of yourself with your fish and show them to all the other fishermen if you like. So it's a pretty fun portfolio. And I know we need to wrap up, so I'll just flip through a few photos because this is the part I like. We love working with the company. Fee Fighters was a company that started out as a marketplace for merchants to get cheaper credit card processing. It sounds really boring, but little merchants pay way too much in processing fees. So this was a marketplace to democratize that. We pivoted, there were issues with that model, we pivoted and built a payment gateway. And the guys were out in New York doing a demo at a FinTech conference, and lo and behold, the Groupon guys were there, and Groupon said, you know what, we want this technology. So they came after us. So this was a company that was an early exit, that we were sort of chased by Groupon. And it's now called Groupon Payments. It's offered to all of the Groupon merchants. So that was kind of fun. I was on the board of that. When there's a team, there's not a lot to show in a digital company, so they did this video, and it got a lot of traffic. They would do anything to drive traffic to their site, so that's them doing insanity at work. Moxie Jean is our kids' clothing company. This was part of Techstars. And again, we're ramping really quickly. This is our team with the entrepreneurs. It's 2 sisters and their mom, entrepreneurs, and that's us in the studio with all the kids' clothes kind of behind us. This was fun. I'm on the board of that one too, so having fun with that. I'm showing you all my favorite ones, right? And then IntelliHot Green Technologies. Does anybody know this company? I thought you might. So they're based in Galesburg, and they have developed a tankless water heater technology that can hold up in commercial environments, which none of the existing tankless can. So we are getting huge wins with there. We're in the 49ers new stadium. out in California. We just installed at a VA hospital. We've got a pilot going with Hyatt and McDonald's. We're in all the Benihana's, Costco's. And this was us at the at McCormick Place, at the Aircon Heating and Refrigeration Show, where I was one of probably 5 women in the whole of McCormick Place. And that's our sales team doing their thing off in the corner, so trying to close a deal. So you can see it's real diverse. And that's it. That's all I have.
Any questions?
I don't know whether we have any time for questions.
I mean, people can stick around.
Yeah, you can certainly stick around. I'm going to be here for a little while. But if anybody has any quick questions that they think the group ought to hear. Yeah?
Can you say anything about your valuation methodologies?
Oh, God. we could talk forever or not at all. You know, it's kind of like you know it when you see it. It's basically, it's kind of like your house, right? You know, you look at comparables and you sort of figure out where it ought to be based on where they are. You know, is the product developed? Is there customer traction? And then it's a supply and demand thing, quite honestly. And, you know, have we paid more than we wanted to in certain cases? Yes. Because there were other people that were trying to get into the deal, and that was just what the market demanded. So right now, valuations are going up. You know, I said it was $2.5 million. The most recent quarter, it was $3 million. And we're just starting to see a lot of interest, which is indicative of a bubble, which I personally think we're in. But, you know, who knows? Time will tell, right? But there's no great, it's not a science, unfortunately. Anyone who tells you that it is kind of just made up. There's this guy called Dave Burkus, and he's a friend of mine, but he's an investor in California, and he created the Dave Burkus methodology. And he sort of assigns you $500,000 if you have one engineer, and if you have, you know, it's like a formula that he came up with. It's a good guideline, but it sounds a lot more scientific than it really is. Any other quick questions? Doesn't look like it. Do you feel like you learned something? Yeah? Was this helpful?
Yeah.
Okay. I have cards. I have a limited supply of Hyde Park Angels stickers, which you should take and put on your laptops and everywhere else if you like the marketing. And, you know, I will be around for a little while, so feel free to come up. Thank you very much. Thank you, Karin.